Hi everyone, thank you so much for joining today's ChemAnalyst webinar. I'm really glad to see participants joining from different regions because today's discussion is extremely relevant for chemical producers, trading company and procurement team globally. Over the past few weeks, we have seen something quite unusual in the petrochemical markets. Normally what happens is the price volatility is either driven by demand cycle, seasonal pattern or the crude oil movement. But what happened today the market narrative has shifted completely. The key driver right now is feedstock risk, and that risk is largely centered around the geopolitical tension in the Middle East and the disruptions around the small corridor, which is Strait of Hormuz. At ChemAnalyst, when we start, speaking with our supplier network last week, we noticed something very unusual and very interesting as well. Some suppliers, what they have done is that they stopped quoting the prices for certain commodities, and others were quoting very limited volume. So the spot volume that were available initially was not being now, and a large portion of the market is currently in what supplier called a watch and see mode. So today's discussion or today's session is designed to answer the three key questions. What are those questions? First is what is happening in the feedstock market today, and second is how is geopolitical tension impacting the petrochemical prices or the petrochemical prices across the globe, and what should be the buyers and producers should expect in the coming months. Now, let me ask a quick questions from the audience. What factors do you believe is currently driving the highest volatility in the petrochemical market? Do you think it is crude oil price movement, or is it feedstock availability, or is it the freight and logistic disruption, or do you think it is the demand slowdown? You can write your answer in the chat box if possible. Interestingly, most of the feedback we are receiving and the answer we are seeing from the market that suggests that the feedstock supply risk and the logistics disruption are now overtaking the demand factors as the primary market driver. And that is exactly what we will explore today. Before we move to the next section, I would also like to briefly understand the profile of the audience joining today. If you're comfortable, please mention that in the chat. Are you primarily from procurement team? Are you from the trading team? Are you from manufacturing end or the market consultants? Understanding, this will help me to focus on most relevant insight for you during the session. Why I ask this question is because the impact of feedstock volatility can look very different depending on where you sit in the value chain. For example, if you are from the procurement team, you will worry more about the price spike. If you're from the traders, you will focus on the market gap and how you can, get that opportunity to sell your product or buy at a cheaper rate. Then comes the producer who are concerned about the operating margins and the feedstock security. So during this webinar, I'll try to highlight the insight relevant for each part of the chemical supply chain. Be it is procurement team, is it traders or manufacturers. I'll try to cover each and every thing here in this webinar. Okay, let's begin with the big picture. One of the most critical supply route for the petrochemical feedstock globally is the Strait of Hormuz. And this corridor is responsible for transporting a massive share of petrochemical material or petrochemical raw material flowing into the APAC region. For example, over 60% of Asia's naphtha imports move through this route. Around 45%, which is a huge number, of LPG import depends on the same corridor or the same route of Strait of Hormuz. So when the shipping disruption occur here, the impact speeds extremely through the key supply chain, and this is exactly what we are seeing today. Insurance premiums for the tanker have increased significantly, and several vessels are already altering their shipping routes to avoid any high risk areas. What makes this situation even more significant is that the disruption has already started affecting the actual petrochemical plant operations in APAC region. One more thing I here wanted to highlight is many Asian producers have very limited naphtha tank storage with approximately 2 weeks of inventory that they have currently in their stock. According to recent ChemAnalyst coverage, several Asian producers have evoked the force measure on supply contracts, which is due to the feedstock delivery delays. One example that I can remember now is Petrochemical Corporation of Singapore, which issued a force measure notices after facing a raw material supply disruptions. Similar developments were also reported at Chandra Ashri Petrochemical, which is in Indonesia, YNCC in South Korea, and some are also even reducing the run rates or their operating efficiencies, like Lotte Chemicals, LG Chemicals, and so on. These examples somehow highlights something very interesting and very important as well. The market is not only reacting to geopolitical headlines now, we are already seeing the operational consequences within the petrochemical industry, and that is when market tends to move very quickly. Let me have one more questions. I just wanted to ask you from you. In your opinion, which feedstock is currently the most vulnerable to supply disruption? Do you think it is naphtha, or do you think it is LPG, or do you think it is methanol and natural gas? So, in our internal ChemAnalyst tracking, we find that naphtha and LPG appears to be the most sensitive feedstock, primarily because Asia depends heavily on the Middle Eastern supply. Another interesting development we are seeing is that shipping companies are demanding higher war risk insurance premiums. These or this increase of freight cost per cargo, which ultimately get reflected in the landed cost of the petrochemical feedstock. So even if the FOB prices remains unchanged, which is not the case, but if it was the case, buyers may still end up buying significantly higher CIF prices. This is something many procurement team underestimate during the geopolitical tension or geopolitical disruptions. But I think we should consider this factor. So, key market intelligence from the ChemAnalyst network. Now, let me share something we are hearing directly from the market. Over the last week, our analyst team spoke with multiple suppliers and distributors across APAC and Middle Eastern countries. Three consistent feedback or consistent theme that emerges is one is either suppliers are holding inventory, what their suppliers are doing. Several suppliers told us that they are temporarily holding the cargoes instead of selling them immediately. This concern, or I would say their concern is also very simple. They know if the supply will tighten further, they may not be able to restock the inventory at the similar cost. So they are just holding their inventory, and some of them just using it for their downstream segment. Second theme which is emerging right now is the limited price quotations. So what suppliers are doing for some feedstock, such as I talk about some important feedstock only, like naphtha, ethylene, benzene, propylene, suppliers are reducing the spot quotations significantly. Our supplier mentioned that prompt cargo availability has become extremely thin in this spot market. Third theme that I could see right now is they which is very unusual in a current chemical scenario, is watch and see strategy. So perhaps the most interesting trend is that many participants are not actively trading. What they are doing, instead of actively trading, they are waiting to see. What they are waiting for, they are waiting to see whether the shipping disruption worsen, or whether the geopolitical tension will escalate, or whether the crude oil market will stabilize. So these are the three factors or three parameters what they are waiting to see. This has somehow resulted in lower liquidity in the spot market, which itself contribute to price volatility. Another factor which is adding to uncertainty in the recent infrastructure disruption is the Middle East. Qatar and UAE hold for almost 20% of the global share in global LNG supply, and the largest LNG buyers are from the region like China, India, Singapore, Bangladesh, and even some European countries like Italy, Poland, and so on. There was an attack on multiple key facilities which has temporarily halted the operation at the industrial hubs such as Ras Lafan and Masid in Qatar, which produces LNG and several petrochemical derivatives, including methanols and a lot of other polymers. So, when facilities like these face disruptions, the impact spread quickly across the methanol markets, polymer supply chain, and even to the downstream chemical industries. So I have one more questions for you. Have any of your supplier recently done any of the following? Because we are seeing this in the market. They might be delaying the shipment, they might be reducing the spot volumes, or might be postponing the price quotations. You can answer to this question in the chat. Okay. So if your answer is yes, then that would align with what we are seeing across the several regions. In fact, some suppliers told us that they are currently quoting the shorter validity period for offers, sometimes only 12 to 24 hours. Because of this, the market direction is changing quite rapidly. Now, let's now look at how the market is reacting globally. At ChemAnalyst, what we are doing is we are tracking the percentage change across the key feedstock since the geopolitical tension has escalated. So I have few products you can see in this presentation. So the naphtha prices have increased from 25 to 35% depending on the different region. Ethylene prices have increased to 17% in USA, 11% in APAC. Propylene prices have gone up to 25%. Styrene prices have increased a lot, which is 38% in APAC, 20% in USA. So what I have done is I have compared the average February prices with the average March prices. That is the 2 week prices that are already published. If I start comparing the prices, February last week prices with the last week March prices, that is 13th of March, the difference would be substantially higher than what you are seeing right now. So benzene prices have also increased by 39%, and highest increase which I could see there is in the natural gas, which is 35% in Europe and 42% in USA. So few interesting observations which I can see through these prices are, first is APAC market are showing the highest volatility. Be it is naphtha, it is styrene, PTA, benzene, all these prices have increased a lot in APAC than when we compare it with Europe and USA. Second is aromatics such as benzene and styrene, they have reacted the most strongly, especially in APAC. And third observation that I have here is natural gas volatility remains high in Europe and USA, which is not the case in APAC, which reflect that energy market is still in the uncertainty. What is interesting here is not just the magnitude of price movement, but also the speed at which these changes are occurring. Normally, what happens is a petrochemical feedstock market takes several weeks to respond to supply disruptions. But in the current situation, we are seeing the price reactions within the days, indicating that the market is extremely sensitive to supply side signals. Let me ask the audience a quick question here. If the feedstock supply remains tight for at least going to next 2-3 months, what do you expect producers will do? Do you expect that they'll reduce their operating rate? Do you think that they'll switch the feedstock wherever it is possible? Do you think that they'll increase the contract prices, or do you think that they'll delay the new production? In reality, what we see is the combination of all these three strategies. Some crackers have reduced the operating rate while others are delaying the new production. Some are also increasing the prices. So we are seeing the combination of all these things. Now let's zoom into the Asia C2 market where the impact is particularly visible. Historically, Asia steel crackers struggled a lot mainly with the margin pressure due to higher naphtha cost. But now the focus has shifted to feedstock availability risk. Asia imports around 86 million tons of naphtha in 2025, and more than half of that supply originates from Middle East. If the disruption continues, the impact on the production could be substantial. Um, Industry estimates suggest that 1 month disruption could lead or could reduce the Asia's ethylene output by nearly 1 million tons, which is a lot. What we are seeing is we are already seeing the operational adjustment. How we are seeing is that cracker utilization rates have declined from 83% to 73% in a lot of Northeast Asian countries. Then cracker utilization rate have declined from 80% to 67% in South Korea. Another emerging concern is the methanol supply disruption. So one example I have is Razi Saudi Methanol Company, which is one of the world's largest methanol producers. They have more than 4 million tons of annual capacity. And we have noted that the shipment disruption has already been there in this company, and if this continues further, the downstream industries such as formaldehyde, acetic acid, construction chemicals, all these downstream industry could experience the stronger price volatility. Now talking about China feedstock exposure. China somehow is also facing increasingly feedstock risk. For example, around 40% of naphtha or China's naphtha imports originate from the Middle East, and roughly 50% of LPG imports come from the same region. And I'm talking about methanol, so nearly 70% of the methanol imports are linked to the same Middle Eastern producers. So, what is happening is that most of the Chinese cracker usually maintain only 20 days of feedstock inventory. So, if the supplier, or I would say, if the supply disruption continues, operating rates could decline further, and that declination would be significantly. Some plants may even consider temporary shutdown if the feedstock deliveries are delayed. Another factor that influences China's response is the government focus on supply security, which might encourage the producers to explore feedstock substitution wherever the technically it is possible, since it's not possible to change the feedstock for all the products. So another important trend we are monitoring is the refinery strategy shift. When geopolitical risk increases, the government prioritizes fuel security over petrochemical production. This often results in refiners allocating more feedstock toward transport fuel, or I would say essential fuel, rather than the petrochemicals. So, in many, or I would say in the industry term, this is sometimes described as more oil, less chemical. So, if this trend accelerates, if this trend will keep on continuing, feedstock supply for petrochemical production could tighten further, which will influence the markets such as benzene, toluene, paraxylene, the immediate, you know, products that are manufactured from refineries. So we are already seeing this dynamic across several markets. The downstream price reaction. Whenever there is any increase or decrease in the prices of the feedstock, it is directly impacting the downstream segment. It is has a direct relation with the downstream segment. So, for example, benzene prices have reached multi-month high globally. European ethylene contract prices have increased. ethylene contract prices have increased in USA as well. It have increased in APEC as well. Then the immediate derivative is MEG. The prices have risen due to supply constraint. Another dimension we are monitoring is the freight and logistic cost escalation. So, several shipping companies are already diverting their vessels away from the conflict affected routes. Obviously, this has the two impact. One is the time will increase, and the other is freight cost will increase. Obviously, if you have to cover the longer distance, the freight cost will be higher. Interestingly, in some market, the largest price increase is not coming from product itself, but from the logistics and freight premiums. So this is something procurement team should monitor closely. So what should we expect going forward? At ChemAnalyst, we see three possible scenarios. First is short disruption. We are seeing maybe the market will stabilize within 4 to 6 weeks. If the situation is not worsened, it is easing out. The second scenario is medium term disruption. So cracker run rates decline and the prices remains elevated and it will continue for a few months. And the scenario third is prolonged disruption. So global petrochemical supply chain will tighten significantly and it will impact the downstream segment a lot. So one key signal we are monitoring is force measure announcements from the producers. Historically, once the multiple producers invoke force measure, it often signals that the market is now shifting from temporary volatility to a structural supply tightening. And that's what we are keeping a track of. Before we conclude, here are the three signal procurement teams should monitor closely. One is freight rates from feedstock cargoes. Second is steam cracker operating rates globally. And third is supplier quotation behavior. If supplier begin delaying the quotes or limiting the volumes, it usually indicate tightening availability. And that is something we are beginning to observe in certain segment of the market. If the current market environment can be summarized in one sentence, then it would be the market is shifting from demand driven pricing to risk driven pricing. And during war driven cycles, supplier security often becomes more important than the price optimization. So, to summarize today's discussion, the petrochemical market is currently entering a feedstock risk cycle rather than the demand cycle. Geopolitical tension in the Middle East is creating uncertainty across the entire supply chain. And because petrochemical depends heavily on the global logistics network, disruption in one region can quickly impact the market worldwide. So we have seen that the major impact now is on the feedstock of in APAC region. But maybe the US and Europe not be buying the direct feedstock like ethylene, propylene, but they are buying the derivatives. So any impact on the feedstock, even if it is in Asia, they are buying a lot of derivatives from APAC region, and any sort of price fluctuation in APAC market is witnessed, it will be reflected back in the Europe and USA market. So at ChemAnalyst, what we'll do is we continue to track these development closely. How we'll do that? We'll do through our supplier network intelligence. We'll track the real time price and also regional market analysis. So thank you everyone for joining the today's webinar. Our team will continue to monitor the situation closely and share the updated market insights as the situation evolves. Thank you.